All right, let's get right into it. Today, we're talking about the high-yield debt trap. It's a danger that's been quietly building just beneath the surface of the economy, and it's something you need to know about.
Just let that sink in for a second. When stocks are all over the place and your savings account is giving you basically nothing, a high, stable yield feels like a godsend. But what if that stability is just an illusion? What if it's masking a much, much bigger risk? So here's how we're going to break this down. First, we'll talk about the why, this incredible thirst for high yield. Then, we're going to pull back the curtain on what that guaranteed return really is. After that, we'll look at the big picture, how the credit cycle is turning, and that's going to lead us to this massive debt wall coming in 2026. Finally, we'll uncover the hidden trap of the smallest exit door and give you a clear playbook on how to navigate all of this.
So, what's really driving all this? I mean, why is practically everyone, from big institutions to regular folks, so desperately hunting for better returns? Well, the answer isn't just about greed. It's a reaction to a financial world that's left a lot of people feeling like they have no good options left.
Yeah, the old safe havens just aren't cutting it anymore. Your standard savings account, it's probably losing ground to inflation. The stock market, it can feel like a total roller coaster, right? So investors are being pushed, almost forced, to take on more and more risk. They're hunting for anything that promises a decent return, and that hunt is leading them straight to the world of high-yield debt, especially into these booming private credit funds. And that brings us to the most important question of all. When you see something labeled high yield, what are you actually being paid for? What's the risk you're taking on? Let's peel back the label and see what's really going on under the hood.
And there it is. The industry has a much less appealing name for this stuff. Junk bonds. Seriously. And that's not just some clever marketing term. It's an official risk classification. These are loans made to companies that are not on the most stable financial footing, and that means there's a very real chance they could default, and you could lose your money. That extra yield isn't a gift. It is your compensation for taking on that very real risk.
Let's look at a real-world example to make this crystal clear. Not too long ago, you could have bought a bond from Bed Bath & Beyond that was paying over 6%. Sounds pretty good, right? But was that a free lunch? Of course not. The market was screaming that this bond was risky. And as we all know now, the company ended up going bankrupt. A lot of those bondholders got wiped out. And this table here, it lays out the trade-off perfectly. With a government bond, you get a low yield, but you're paying for safety and certainty. With a speculative or junk bond, you get that high yield, but you are being paid to accept the very real risk of a company failing and you losing everything. Okay, so the risk of one company defaulting is one thing, but what happens when the entire economic tide goes out? This is where something called the credit cycle comes in. Think of it like a hidden engine that can take all these individual risks and amplify them into a massive market-wide problem. This quote just nails the dangerous part of the cycle, something called a deleveraging. See, when times are good, credit is flowing, it's cheap, it's easy. But when the cycle turns, everything that worked on the way up starts working in reverse, and it feeds on itself, creating this nasty downward spiral. So this deleveraging, it unfolds in a pretty brutal sequence. It all starts when people's incomes start to fall and credit suddenly dries up. To get cash, people are forced to sell whatever they own, stocks, real estate, you name it. But when everyone's selling at once, what happens? Prices collapse, and that tanks the value of their collateral, which makes it even harder to get a loan. And the whole vicious cycle just reinforces itself, spiraling down.
Now, this isn't just some abstract economic theory. Oh no. This process is building towards a very specific, very foreseeable event. And this is really the core of our warning today. What's being called the 2026 Wall of Maturity. I want you to imagine billions upon billions of dollars in loans, all taken out when money was basically free, when interest rates were near zero. Now imagine all of those loans coming due at the same time and needing to be refinanced in a world where interest rates are dramatically higher. That's the storm that's brewing. And this is the scale we're talking about. According to the data, it's around $1.8 trillion. A number so huge, it's honestly hard to wrap your head around. This isn't a small wave we're talking about. This is a potential tsunami of debt. So here's the bottom line. This massive pile of debt, most of it in commercial real estate, was born during the easy money days of 2019 to 2021. And now it's all coming due at once. These property owners have to go out and get new loans in a much, much more expensive credit market. A lot of them won't be able to, and that could trigger a huge wave of defaults and forced sales. And this brings us to what might be the most overlooked danger for individual investors caught in this whole mess. When everyone realizes the party is over and they all rush for the exit at the same time, they discover something terrifying. The exit door is far, far smaller than the entrance. This is the danger of illiquidity.
This image just captures it perfectly, doesn't it? During a boom, when everything's going up, selling is easy. There are buyers everywhere. But in a bust, the buyers disappear. The only people left are other desperate sellers, all stampeding for the same tiny exit. And when that happens, prices collapse, and your investment gets trapped. And this is the result. This rush to sell isn't some neat, orderly line. It's a panic. It's the moment when all those losses you saw on paper become very real, irreversible losses. And it creates a cascade effect, where one falling asset class starts to drag everything else down with it. Okay, so we've laid out the problem, we've outlined the risks. I know it sounds pretty grim, but it's not hopeless. The key is to stop thinking like a speculator and to start thinking like an intelligent investor. So, what's the playbook? How do you survive and maybe even find opportunities in an environment like this? The key here really is discipline. First, you have to treat these junk bonds like you're buying a piece of a company. You have to analyze the business. Is it actually solid? Second, you absolutely must demand a margin of safety. A good rule of thumb is to only buy this stuff at a deep discount, say 70 cents on the dollar or less. Third, you've got to scrutinize the financials. Does this company have enough cash to survive a recession without needing new loans? Check their liquidity. But, it goes even deeper. You have to understand the fine print of the fund you're investing in. Many private credit funds have something called gate provisions. That's the legal jargon that allows them to literally lock the exits and freeze your withdrawals in a crisis. This is the brutal truth. They can trap your capital for months, even years, while the assets inside are plummeting in value. And finally, don't get seduced by flashing marketing numbers. They'll show you this amazing internal rate of return, or IRR, but that can be manipulated. You need to focus on the MOIC, the multiple on invested capital. It's a much simpler question. If I put $1 in, how many dollars do I actually get back? At the end of the day, a balanced portfolio across different asset classes is still your single best defense. So ultimately, it really all boils down to this one question. Those high yields are incredibly tempting, but they are never, ever free. There is always a hidden risk. But by understanding how the credit cycle works, by being aware of this coming wall of maturity, and especially by understanding the trap of illiquidity, those lockup risks hidden in the fine print, you can make sure that in your quest for returns, you're the one making the intelligent choices, and not the one who ends up as the market's prey.